sure you understand the idea. All right, so now we're looking at an equity investment real quick. We have 3 different purchases of stock, because we got shares. That's how you know we're buying stock. This is how much each of those cost. We purchase share of common stock. None of these create significant influence. So let's see. These are going to be in the passive, the less than 20 category for the equity investments. And what is the initial entry going to be? All right. Well, I'm going to record them straight away in one entry. So I'm going to have investment in mining, investment in toys and things, and an investment Situation Corp, credit to cash. My credit to cash is for the sum of those 3, and the debit is just whatever they cost me, right? The fair value, that's how we record assets when we initially acquire them, just like we did in Chapter 10. Right, so this is assets up, assets up, assets up, and assets down. So there's my entry. Not the prettiest writing, but you get the point, right? It's recording those at fair value. All right, so the next activity is looking at the end of the year and looking what has happened with those passive equity investments. And we have some information about what has happened during the year. And so we see that there was a dividend declared, $1 a share by Situation Corp. And we had 3,000 shares. And then we also had information that there's nothing in the fair value adjustment equity securities account. And we have a table at the bottom that gives us the fair values. And these carrying values are what we paid originally for those stocks. So that's the cost basis. So we just have a few entries to make regarding that subsequent measurement. The first one we're going to make is for the dividends. I'm just going to do it. It's kind of a standalone thing, okay? Oh, go. Dividends were declared. That means we got cash, right? Made our assets go up. Cash, and we got dividend revenue, which you guys correctly recognize. That goes on the income statement. It's $1 a share, and we have 3,000 shares, so that is pretty straightforward entry. You want to make sure you get that one on the test, right? Record dividend revenue. All right, there's that one. If the stocks are publicly traded, which level in the hierarchy? Well, if you flip back and look at that levels, if there is a publicly traded stock, that's very observable. It's can be quoted in an active exchange. That's going to be level 1. Remember, GAAP says you have to use level 1 if it's available. So if it's publicly traded stock, then that would be level 1. What value balance is going to be reported for each of these investments? It should be their fair values, because you guys correctly told me that passive equity investments are reported at fair value. All right, number 4, what balance is in the general ledger? Right now, it's their historical cost. Okay, if you want to think of it that way, that's what's in the general ledger for each of those accounts. We're not going to change the general ledger investment account. It's going to stay at cost. How does the fair value adjustment equity account affect the accounting equation? It's going to be affect assets up and down depending on where the fair value goes, right? Depending on where the fair value moves to. Okay, so we're just going to do one entry to record this fair value adjustment. And I'm really simply just going to say, okay, the fair values sum up to 130. The cost was 120. So my fair value adjustment needs to be for my equity, securities, equity. It needs to be for 10,000. Assets up. And the unrealized gain, remember, because I haven't sold anything, so it's an unrealized gain. Loss. This is going to the income statement for passive equity securities. They go to the income statement. All of those value changes flow through the income statement for that passive equity securities. So this is what my entry is going to look like. Okay, so now if you thought about what was in the general ledger, I'd have these investment accounts. I had 3 different ones, didn't I? That was crazy of me. Okay, so we have those at cost, and then we have our fair value adjustment. Just I want you to keep in mind this is a permanent account, fair value adjustment, which means the next year it's going to have this balance, $10,000 in it. And I would need to reevaluate at the end of the year, what should the balance be in fair value adjustment? And when I fix the balance, that's going to tell me whether I have an unrealized gain or a loss. But there you go. Pretty straightforward. Passive equity investments. We have a little bit of a quiz. Unrealized gains on passive equity go into other income or expense